When is the right time to refinance your mortgage? Most homeowners typically consider refinancing to reduce their interest rate and lower their monthly payment. But it's crucial to look beyond just interest rate in deciding to refinance. I've heard people say this all the time. If the rates are 1% lower or 2% lower, you should refinance. To me, this is a poor way to decide. For example, a 1% reduction on a large loan amount like $800,000 could significantly lower the monthly payment, potentially making the refinance beneficial. However, the same rate reduction, 1% on a smaller loan like $50,000, might not offer enough savings to justify the cost. A better way to look at refinancing is your break-even point. This is where the cost of refinancing equals the savings. And all you have to do to calculate this is divide the total cost of refinancing by the monthly savings. The result tells you how many months it will take for you to recover that cost. If you plan to stay in your home longer than the break-even period, refinancing might be a worthwhile decision. Now, sometimes refinancing to a higher rate might even make sense, especially if you're using this opportunity to consolidate higher interest rate debts. I believe the last debt you should pay off is your mortgage. This is because it often comes with a lower rate compared to your other debt, and your other debt doesn't have the potential tax deduction on the mortgage interest. In summary, the right time to refinance isn't just about chasing lower rates. It's about analyzing your financial situation and understanding the cost versus the benefits, and making sure it aligns with your long-term financial goals.